The US mortgage market is an absolute free fall right now because the level of mortgage applications to buy a house, that just hit the lowest level since 2010, the middle of the last housing crash. A signal that home buyers continue to go on strike from the US housing market. It's too expensive and everyone knows it, and thus these record low levels of demand, which are going to cause prices to continue to go down, especially in cities like Austin, Texas. The median sale price in Austin has already gone down a whopping 14% in the last 5 months, according to Redfin. And as this video goes along, I'm going to discuss more and more cities in terms of how much prices have already declined and how much they're going to decline into the future. But before getting into that, I want to make sure you all understand just how important this data on the mortgage market is. Because according to Realtor.com, 75% of home sales use a mortgage to complete the transaction. According to you guys on this channel, when I polled you, 80% of you are looking to buy with a mortgage. So a drop in demand for mortgages means a drop in the US housing market. And no doubt, higher mortgage rates over the last 6 months are one of the main reasons that buyer demand has dropped off a lot. But increasingly, there's another reason why home buyers are dropping out of the market. And that's now that the expectation of home price declines is setting into the regular home buyer frame of mind. If you look at data from the Fannie Mae housing survey, you can see that in September 2022, that was the first month in the history of the Fannie Mae housing survey, outside of 2 months during the lockdowns when the pandemic hit, that more Americans are expecting home prices to go down than are expecting home prices to go up. That's very rare. You can see for most of the last 11 to 12 years, Americans are very bullish on the housing market. Way more people typically expect home prices to go up than to go down, but we're in the exact opposite situation now. And so the longer this situation lasts of the housing market being viewed negatively, being viewed as a bad investment, the more that people are just going to be turned off to buying a home in general, regardless of what happens with interest in mortgage rates. And that's something I want to talk about a little bit here, because I know some of you are kind of discouraged right now by the really high mortgage rates. You know, you see maybe the prices are down 10% in your city or in your neighborhood, but you don't feel great about that because the mortgage rate went from 4 to 7%, and that's understandable. However, I'm predicting that the US home buyer is going to get something I call a double-double over the next couple years, where there's going to be declining prices and declining mortgage rates. It's going to get better in two ways for you as a home buyer over the next couple years. And the reason I feel confident in predicting that is looking at what happened in the last housing crash in 2007, 2008. Take a look at this, everyone. Back in 2007, we can see the mortgage rate actually went up to around 6.5%. That was just as home prices started to go down in America in 2007. But what really I want you to pay attention to, everyone, is look what happened over the next 5 years. Both mortgage rates and home prices went down significantly in America during that last housing crash, creating some of the best buying opportunities of all time back in 2010, 2011. And some of those same buying opportunities are going to present themselves in this housing crash. Because I want you all to think about something about this housing market, right? Like we talked before about how mortgage demand is at a 10-year low. But what's amazing is that mortgage demand is at a 10-year low while the unemployment rate in America is still 3.5%. So you got to ask yourself, what then happens to mortgage demand when the next stage of the recession takes hold? Like when the layoffs really start leveraging up through the end of this year and early 2023? What's going to happen to home purchase demand and mortgage demand then? Well, it's going to go down even further. That suppressed buyer demand is going to occur alongside a huge level of new home building completions, a big surge in foreclosures, and a lot of people being forced to sell because of the economic situation. So it's really important for us to be forward-looking with the housing market. I mean, that's what I attempt to do on this channel. It's what I did a year ago when I was predicting the housing crash when everyone else was saying home prices would go up forever. Well, now the housing crash has obviously started, but now there's a whole new host of narratives and frustrations and all these other things that are confusing people. So it's always important to understand, where is the ball going in the future? And the ball into the future is going into a recession, it's going into more inventory, it's going actually into a declining interest in mortgage rate environment. Historically, in recessions, mortgage rates go down. And when they go down, that's good news for you as a home buyer. But interestingly, it's not such a clear-cut situation that it's good news, because then there's a recession taking hold and certain people lose their jobs. And other people say, because of the recession, well, even though mortgage rates are lower, I don't want to buy during a recession because I think prices are going to go down more, kind of what Americans are already starting to feel. So understand, actually, at a certain point, everyone, the mainstream narrative is going to shift into a direction of people are going to think, even after home prices are down, say like 30% in a certain market, like maybe in Austin or some other cities I'm going to talk about, people are going to think at that point, housing is such a bad investment that I don't want to buy. And you're going to be viewed as crazy if you want to buy a house in this point in time in the future, just like people were viewed as crazy in 2009 and 2010 who bought a home, which is why it's so important to have a data-driven perspective that's forward-looking, that's not contingent on what the narratives are. Because when I see in a market like Seattle that home prices are down by 10%, according to Redfin, over the last 5 months, I say, that's great. The median sale price is down by 10%. But I know that that's going to go down more, because when we look at the PE ratio, the price to earnings ratio in Seattle, taking the typical home price and dividing it by how much the average worker makes, we can see there's still another 20 to 30% decline left before the local home buyer in Seattle can afford a home, which will then be the point in time when we hit that yellow line that it's a good time to buy. Same thing in Southern California, whether in Orange County or Los Angeles County or San Diego County. These areas have gone down by about 10% in sale price over the last 5 months, according to Redfin. However, there's more to go. These Southern California markets are still overvalued anywhere from 15 to 20%, according to my PE ratio metric. And so when we get closer to this yellow line in Southern California, you're going to know from a fundamental perspective, the local wages and earnings start justifying the home prices. That'll be the time to get in. Some other markets with pretty big price declines already include Ogden, Utah at 11%, Boulder, Colorado at 11%. DC is actually down 9% in sale price according to Redfin. Sacramento is down 9%. Reno's down 9%. Boise's down 7.5%. These are actually really sizable declines for only 5 months. Typically, home prices don't actually go down that fast. Even if it seems like, the prices are still high, which they are, we got to acknowledge that those type of reductions in a 5-month period is a big deal. Like the last housing crash, starting in 2007, prices did not go down that fast. We could see in America, it was like 0.5% a month, 0.5% a month, 1% a month. And then it was really in 2008 where prices fell off the table. They really, really dropped. So that's also an important thing to remember from a home buyer perspective, right? That a housing crash is typically a slow motion crash. It's not like the stock market where all of a sudden in a day or two prices are down 50%. It takes some time for sellers, especially in the housing market, to wake up and to exit the denial stage, because we still have a lot of sellers who are kind of off the reservation, who are sticking to like a really high list price, who aren't cutting their price, who aren't recognizing what's going on in the market. That's because the nature of being a seller is one that you're emotionally attached to your house. You think your house is worth a certain amount, and you're going to want to get that amount, even if the reality isn't presenting it to you. And in the same way, a lot of people think that about their city. We have prices down 14% in Austin, or 15% in the Bay Area, or 10% in Anaheim. A lot of people aren't aware of that, actually, who are sellers in these cities, and they think, oh, it's a dip, it'll bounce back. But eventually, the sellers all come around. They get out of their own way, and they're going to be forced to get out of their own way by factors that are out of their control completely, like a recession. A seller might say to themselves, oh, I don't want to cut the price, or I'm not going to sell because I have a 3% mortgage rate. Seller might think that, but then all of a sudden, if they lose their job, or if their local economy tanks, or if home builders flood their local housing market with new inventory, well, there's nothing the seller can really do about it. And eventually they're going to have to sell for one reason or the other with where the economy and the housing market is heading. And it's at that point where, the capitulation is going to get crazy. It's going to be like a Lehman Brothers September 2008 moment where everyone snaps out of their trance at once, and all of a sudden you see everyone cutting the price significantly, and it becomes real pandemonium. Lastly, I need to leave you all with a warning about banks and mortgage lenders. The supply side of the mortgage market right now, the people who issue these loans, they're really starting to tighten their lending standards. When we look at mortgage credit availability, also tracked by the Mortgage Bankers Association, we can see lending standards are the tightest they have been in a decade since the last housing crash. So we're entering a situation in the housing market where the demand for mortgages is going down and the supply of mortgages is going down at the same time, which is going to be a nasty combination for home prices. But the thing I want to leave you with is that if you do want to take advantage of this housing downturn and buy a house at a really good discount, buy the house you want at a 20 or 30% discount, it is going to be important, in my opinion, to have a big down payment. You're going to want to save as much money as possible for that down payment. Because if you can get to that like 30% down, which is a lot, that's way higher than the US average down payment, but if you can get there, you're going to get yourself a lower mortgage rate, and you're going to get yourself a lender who's more willing to work with you on that loan. That big down payment is also going to give you more cushion and more room in the event, say you buy in 6 months at a discount and then prices go down more. You're going to want that down payment to give yourself some breathing room so you're not immediately underwater on your mortgage after you buy. In certain cities, especially the pandemic boom towns that built all these homes and saw home prices go way up, they are going to have a very, very long recovery after that last housing crash. It took states like Arizona and Florida 10 years to get back to their peak values. In fact, if we go back to the 1980s, Houston had a big housing crash in the 1980s, and it took about 15 years for values in Houston, which peaked in 1982, to get back to that level by 1997. And so some people kind of have this perspective that there's going to be a quick dip, flash crash, 20%, you're going to get a deal and then you're going to be good, there's going to be no more price declines. That's probably not going to work that way if you're someone looking to buy in the next 6 to 12 months. Get ready for buying at a discount, but then also potentially facing even more value declines after that. And that leads me to a question, everyone, and how I'm going to end this video is your perspective on buying a home right now. Is it more like you want to see, a 10% correction, 15% correction with lower mortgage rates and like you're going to buy right there? Or are you really looking for value? Are you looking for, I want to buy closer to the bottom, values are down by 30% or 35%, maybe mortgage rates are down below 4%. What's your perspective on when you're going to pull the trigger? Do you need to buy at the bottom, or are you just looking for moderate relief from where we are today and you don't mind maybe buying at moderate relief if prices go down further after that? I want to hear your perspective on that in the comment section, so let me know below.